Every investor hopes to invest at the beginning of a bull market. Every investor wants to exit at the beginning of a bear market. But the paradox is, nobody knows when either of them begins. Only hindsight reveals where a bull market started. Only time confirms where a bear market began, because markets are lived looking forward but only understood looking backwards. So the real question is, if nobody knows where we are in the market cycle, then how do experienced investors make decisions today while everyone else is reacting to headlines? Today in Signal episode 34, let's decode what exactly defines a bull market and a bear market. How to recognize them? Where do the Indian markets stand today? And most importantly, how do long-term investors navigate both? Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. Let's begin with definitions. A bull market is a prolonged period during which the overall market keeps going up, supported by positive corporate earnings, economic growth, and investor confidence. India has witnessed many strong bull markets over the years. Following 2000 dot-com bubble, Indian markets entered powerful bull run between 2003 and 2008. The next major bull run began after the 2008 global financial crisis and lasted almost the whole decade, despite periodic minor market corrections. And after COVID-19 crash in 2020, Indian markets entered another strong bull cycle that eventually led the markets to its new highs. Unlike other investment concepts, there isn't a universally accepted percentage or mathematical threshold that quantifies or defines the start of a bull market. In fact, that's one of the paradoxes of investing. You rarely know that a bull market has begun while you're living through it. You only recognize it months and even years later when you look back. A bear market, on the other hand, is much easier to define. When a broad index like Nifty or Sensex falls 20% or more from its most recent peak and remains under pressure, it is considered to have entered the bear market. If the decline is between 10 and 20%, it is correction, not a bear market. So are we actually in a bear market? Let's check the numbers. In January 2026, Nifty reached its most recent high of nearly 26,373 points, and as of yesterday, the 24th July 2026, it closed at about 23,767 points. Now that's a decline of roughly 10% from its most recent high, not 20%. Now let's look at the Sensex. Sensex reached its most recent high at about 86,159 points, and as of yesterday, the 24th of July, closed at about 76,060 points. Now that's a decline of roughly 12% from its most recent peak. So based on these benchmarks, neither the Nifty nor the Sensex are in bear market. Both are currently experiencing a market correction because the decline is between 10 to 20% from its most recent peak. India is not currently in a bear cycle. One of the effects of bull market is that it creates excitement. Excitement creates optimism. Optimism creates confidence. And sometimes that confidence creates greed. Conversations would sound like, hey, do you know, this stock doubled. My next bonus, I'm going to invest in stock markets. Why don't you invest in stock markets too? You don't want to miss this opportunity. And when markets fall, before they even enter bear market, they create caution. Caution creates uncertainty. Uncertainty creates doubts, and sometimes those doubts turn into fear. And suddenly the conversation shifts to, what if I lose even more? Should I stop investing? Should I sell my portfolio? I should have invested in fixed deposits. But as sentiment shifts, what gets overlooked is that businesses don't change overnight. Reliance doesn't suddenly become a bad company. HDFC doesn't suddenly stop serving its customers. Infosys suddenly doesn't forget how to build software. Bull markets are driven by optimism. Bear markets are driven by fear. What first changes is investor sentiment. These sentiments create volatility, and this volatility creates opportunity. An opportunity for disciplined long-term investors. But how do disciplined long-term investors recognize that opportunity? They start by asking two different questions. Has the business changed? Or has only market price changed? They clearly separate business risk from market risk. Secondly, experienced investors don't treat volatility as an instruction to buy or sell. They treat it as an information. Their investment process does not change because of price movement. And before making investment decisions, they ask, why are markets falling? Is it because of sentiment? Is it because of corporate earnings? Is it because of change or shift in economy? Is it because of geopolitical issues? Or has the business fundamentally changed? Experienced investors prepare way before bear markets arrive. This means they are ready with emergency cash, asset allocation, investment plan, watch list. When markets fall, they execute. They don't invent a strategy then. Experienced investors usually have a written investment framework. Decisions like I'll deploy cash at 10% correction, I'll rebalance on an annual basis, I'll continue with SIPs regardless are taken way before market volatility. Market volatility simply triggers the execution. It doesn't change their strategy. So should you actually invest in a bear market? Well, that depends. If you are investing for short term, then short term volatility or short term market movements can definitely matter. But if you're investing for long term wealth creation, then remember, as long as people continue to live, work, consume, and aspire for better life, businesses will continue to produce, innovate, grow, and create value. And that's what will drive a bull market and long-term wealth creation. And if you're still unsure, please seek an advice from a SEBI registered investment advisor who can guide your investment decisions to suit your personal circumstances. And that brings us to the conclusion of Signal episode 34. But before I go, let me ask you this question. Are bull and bear market cycles creating wealth for you or simply testing your conviction?